What I think's changed in markets between 2017 and 2018 is, in a word, volatility. In October in 2018, there were more days when the market was up 1% and down 1% and greater than in the entirety of 2017. That's the headline that everyone is focusing on. I think these are normal market conditions. I think, again, going back to 2017, 2017 was out of the blue. What we're seeing now, the volatility that we're seeing in 2018, is very much representative of historical volatility levels. It may feel more painful in terms of the headlines, in terms of everyone worrying about markets, but actually it's more representative of where we've been. Less of the world is paying attention to Brexit. It's moving the pound, it's moving the stock market, but there are a lot of macro issues in 2018 that we need to focus on that are causing the markets to move a lot more. You've got Italian debt, you've got the Italian government and their kind of non-compliance with the EU budget. Obviously the main headline that seems to be grabbing everyone, which is the US-China trade tensions. The headlines themselves aren't making me nervous, it's the market's reaction to the headlines. The markets are just moving in much larger fashion than they were in 2017. The hardest part of investing in 2018 is that everyone is so nervous that we're allowing headlines to affect short-term sentiment a lot more. All of these quality investments that we had in 2017 that still stand up are being disproportionately affected. The nervousness of investors is causing the good to be sold off with the bad. It's difficult to remain positive about markets in 2018 when you look at the short term. There's so much bad news in the pipe, in the macro pipe, as it were. What you have to remind yourself is that these are short-term factors, and in the longer term, in the medium to long term, there is good news. There will be good news, and you will start to see some repricing as people take off some of that negativity. And what one needs to do is one needs to focus on the medium to long term and invest for the medium to long term. Clients can expect to see from markets in 2019 much more of what they saw in 2018. You're going to see volatility returning. You're going to see headlines that usually in 2017 wouldn't have affected the markets. You're going to see them have a much larger effect on stock markets. You're going to see those returns going from 1-2% up to 2-3% down. And you're going to see that going through the entire year potentially. With heightened volatility, you're going to need more defensive assets. You're going to need a higher cash value. You're going to need to hold quality assets that move in the opposite direction. 2019 will be much more about capital preservation than it will be about capital generation. And that's what we need to make sure is that quality asset classes that are oversold, we're buying and putting into the portfolios. But at the same time, we're buying those defensive assets that ensure that should we have a negative year, we've got that robust defense in the portfolio. We want you to know that we're ready for 2019 and whatever markets throw at us.